Hello everyone, welcome to my channel, and today we're going to discuss the power of dividend investing. So dividend investing is one of the most reliable ways to generate passive income whilst building long-term wealth. But how does it work, and how does it compare to other strategies like growth investing? We're going to break it all down in today's video. So what is dividend investing? It's a strategy that focuses on buying stocks from companies that regularly pay dividends. This is cash distributions from a company's profit to its shareholders. These stocks provide investors with a steady stream of income, and in addition to any potential stock price appreciation. Instead of relying solely on selling shares for profit, dividend investors aim to build a portfolio that continuously generates passive income, which can be reinvested into the same stocks or others, or used as free cash flow. If you do end up choosing to reinvest the dividends that are paid out to you from the shares that you own, this is known as the snowball effect, which refers to the power of compounding dividends over time. So how does that work? You buy dividend paying stocks, these stocks then pay you dividends, you reinvest those dividends to buy more shares lead to higher future dividends, which over time this cycle accelerates, just like a snowball rolling down a hill, and grows bigger and bigger. If you reinvest dividends consistently, your portfolio can experience exponential growth over decades, making it an ideal long-term wealth building strategy. So if you buy, say, 1,000 shares of Microsoft right now, and you only reinvest the dividends that you get paid out, in 20 years time you could have another 1,000 shares of Microsoft, for example. So it is effectively using free money, so to speak, to buy more shares, which leads to greater dividend payouts. So what are the main differences between dividend investing and growth investing? So dividend investing focuses on income from dividends and stock price appreciation, whilst growth investing only focuses on stock price appreciation. The risk level of dividend investing is generally lower, whilst the risk level of a growth investment is generally higher. When it comes to reinvestment, in dividend investing it is often reinvested dividends for compounding, whereas with growth investing it is reinvested profits by buying more shares. When it comes to market conditions, dividend investing is less affected by downturns, whereas growth investing is more sensitive to market crashes. And the time horizon for dividend investing is ideal for long-term investors, whereas growth investing is ideal for those willing to wait for high growth. So what are the pros of dividend investing? It can offer the opportunity of passive income, which provides a reliable source of income depending on the stocks that you invest in. It is generally lower risk, like mentioned before, so dividend stocks are often large, established companies with steady earnings. There is a compounding potential, so reinvested dividends accelerates wealth accumulation. Dividend investing can be used as a hedge against market volatility, as it can cushion downturns. And if you pick the right companies that grow their dividends year on year, it can offer inflation protection if the growth rate of the dividends is higher than inflation year on year. However, whilst there are a few pros of dividend investing, we've also got to consider the cons. So there is lower growth potential because dividend paying companies often prioritize stability over expansion. There is the risk of dividend cuts, so companies can reduce or eliminate dividends during economic downturns or if their performance takes a hit. You may have to consider tax implications, so dividend income may be taxed depending on your country and tax bracket. And there is reinvestment risks, so reinvesting dividends may not always be beneficial if the stock prices are overvalued. So what are the key characteristics to analyse when looking at a dividend stock? Firstly, you'll want to look at the dividend yield. This is a percentage return based on the current stock price. Too high of a dividend yield could indicate risk, or you need to be cautious that that's trying to lure you in and the dividends will get cut drastically. You need to look at the dividend growth rate. So this shows how consistently dividends have increased over time. You ideally want something that keeps in line or beats inflation. Otherwise, you're not really growing with inflation, so you're losing out on money. You need to look at the payout ratio, and this shows the percentage of earnings paid as dividends. General rule of thumb is the lower the safer. Obviously it depends on the type of stock you're actually investing in. You will also want to look at the earnings stability. So companies with consistent profits are more likely to sustain dividends, and you will want to look at the industry position. Market leaders with competitive advantages tend to have reliable dividends. However, when looking at dividends, like any other stock, there is different categories that they can be put into. So we have 5 categories that we're going to go through here. So we've got dividend aristocrats. This is companies that have increased dividends for 25 plus consecutive years. An example of this would be Procter & Gamble. I believe there's even a fund that tracks S&P 500 dividend aristocrats. You can get high yield stocks. So this is stocks with above average dividend yields, for example AT&T. You can get dividend growth stocks, and this is companies that steadily increase their payouts over time, like Microsoft. You can get REITs, which stands for Real Estate Investment Trusts. So this is high yield real estate investment stocks like Realty Income. And you can get MLPs, which is Master Limited Partnerships. This is high dividend energy and infrastructure stocks, for example Enterprise Product Partners. So who should be investing in dividend stocks? Dividend investing certainly isn't for everyone, but it's great for the following group of people. So retirees and income seekers, as this provides steady cash flow for living expenses. It is also fit for long-term investors, specifically those who want to build wealth through compounding. It is suitable for conservative investors due to lower volatility compared to high growth stocks. It is great for passive investors, which is people who want a hands-off approach, and it is amazing for anyone seeking financial freedom, as it can help replace earned income over time. But if you're looking for fast, aggressive growth, dividend investing alone might not be the best fit. So to conclude this video, dividend investing is a powerful strategy for generating passive income and long-term wealth. So whether you're planning for retirement or just looking to build a reliable income stream, dividend stocks can be an excellent addition to your portfolio. If you're wanting to start, I would look for strong companies with stable dividends, low payout ratios, and a history of dividend growth. And over time, the snowball effect will do the rest. But please bear in mind that when you're looking at different stocks and different type of dividend stocks, different factors need to come into it. So don't take any suggestions or advice from this video as financial advice, and just remember your capital is at risk when investing. If you've enjoyed this video, please leave a like and subscribe for more. Comment any videos you want to see or any stocks you want me to analyze, and I will see you in the next one.